UiPath Inc. is currently trading at $16.90 USD, which marks an intraday increase of 93 cents or 5.86%. This upward movement today suggests a significant shift in market sentiment as traders react to the latest technical setups and fundamental updates within the software automation space. While many look at this stock and see a company that specializes in the older world of simple task automation, the actual development under the hood is much more sophisticated. The common belief among retail investors is that UiPath is a legacy player losing ground to newer large language models, but the reality is that the company is repositioning itself as the primary infrastructure for AI agents. This transition is less about replacing humans and more about providing the digital nervous system that allows AI to actually do work rather than just talk. While everyone is chasing the massive gains in NVIDIA stock or looking for the next breakout in Tesla stock, there is a quieter but equally intense battle happening in the enterprise software layer. When you look at the current price action, it is clear that institutional players are beginning to recognize that if an AI model cannot actually click a button or navigate a complex ERP system, it is functionally useless for a business. That is where UiPath fills the gap. However, before you jump into a self-investing plan or search for the best investing sites to pick up shares, it is important to understand why the stock has been so volatile. Even with today's nearly 6% jump, the stock has faced heavy resistance throughout the year. Institutional activity has been mixed. We recently saw Asanagan Asset Management cut its position by over 28%, and we have seen consistent selling from the founder and CEO Daniel Dines. Over the last quarter, insiders have offloaded millions of dollars in stock. Usually, when a founder sells, people get nervous, but in this case, Dines still owns a massive 23% of the company. The expectation was that these sales would create a permanent ceiling on the stock price, yet the reality of the third quarter earnings beat has forced a reevaluation. The company reported revenue of $411.1 million, which was nearly 16% higher than the previous year. More importantly, they achieved GAAP profitability, a milestone that many analysts thought was still a year away. If you are using a Fidelity trading platform or a Robinhood app to track your individual brokerage account, you might have noticed the volume spike. Today's trading volume is trending well above the daily average of 15 million shares. This suggests that the current move is not just a random fluctuation, but has institutional backing. For those into online investing through platforms like SoFi Invest or Interactive Brokers, the technical setup is becoming a main focal point. The stock is currently fighting to stay above its 50-day moving average of $15.47. If it can hold this $16.90 level and build a base, the next major resistance is near the $20 mark, which has been a psychological barrier for most of the year. The broader market narrative is currently dominated by the massive capital expenditures from companies like Microsoft and Alphabet. Many investors are using investment help from services like Schwab Intelligent Portfolios to manage their risk, but for the active trader, the individual paths of companies like UiPath offer a different kind of opportunity. The tension here is that the market wants to see AI software revenue now, not in 3 years. UiPath is delivering that revenue today through their annual recurring revenue, which has hit $1.78 billion. This is a massive number for a company with a market cap around $9 billion. Comment below how many shares of UiPath you currently hold, or if you are waiting for a better entry point. The business model for UiPath is centered on the concept of agentic automation. They are moving away from simple repetitive robots that follow a script. Instead, they are building agents that can reason and make decisions within a governed framework. Think of it like this. If Apple stock represents the hardware and consumer interface of the future, and NVIDIA stock represents the brain power, then UiPath is trying to be the hands and feet. They provide the software that lets an AI model log into a legacy banking system, move data, and process an invoice without a human having to guide every single click. Expectations were that generative AI would kill UiPath because people could just ask ChatGPT to write code. The reality is that enterprise environments are too messy for that. You can't just give an LLM access to your entire corporate database and tell it to figure it out. You need the security, the governance, and the integration layers that UiPath has spent years building. This is why their integration with SAP and their partnerships with companies like Anthropic are so significant. They are becoming the layer where AI actually meets the real-world business process. For those using Fidelity Investments or SoFi Active Investing to build a long-term position, the risk remains in the execution. While the company is now profitable on a GAAP basis, their net revenue retention has ticked down slightly to 107%. This indicates that while they are gaining new customers, the existing ones are growing their spending at a slower pace than they were 2 years ago. This is the reality check that prevents the stock from simply skyrocketing. It's a grind, not a sprint. The market is waiting to see if the new agent builder tools will lead to a re-acceleration of growth in 2026. When you compare this to other players in the space like Palantir, you see a massive valuation gap. Palantir is trading at multiples that are through the roof because of its perceived lead in AI orchestration. UiPath is trading at a much more modest price-to-earnings ratio of around 38. For a value-conscious investor looking for online investment options, this makes Path an interesting contrarian play. It doesn't have the same hype as a Robinhood crypto trade, but it has the actual cash flow and enterprise footprint that long-term investors in Fidelity mutual funds or Fidelity ETFs often look for. Looking at the macroeconomic pressures, the software sector has been hit by the high interest rate environment, which makes future cash flows less valuable today. However, as we see a shift in the Federal Reserve's stance, the pressure on mid-cap tech stocks might start to ease. If you are doing your own self-investing through an Interactive Brokers account or a Robinhood Investments profile, keep a close eye on the 10-year Treasury yield. When that yield drops, companies like UiPath tend to get a valuation boost because their long-term growth looks more attractive. The company's core product involves 3 main segments: the Automation Cloud, the Automation Suite, and Professional Services. Most of their revenue comes from subscription licenses. This provides a very predictable stream of income, which is why the annual recurring revenue is the most important metric to watch. Their recent quarterly report showed that they are still adding customers with over 100,000 in annual spending, which shows that the enterprise demand remains healthy despite the competition from other investing sites' favorite tech giants. What often gets missed in the noise of daily market swings is the importance of the human-in-the-loop feature. UiPath is not trying to fully automate companies into ghost towns. They are focused on the collaboration between AI agents, robots, and human employees. This is a more realistic approach to enterprise technology than the total replacement narrative. When you look at your intelligent portfolio or your Fidelity Wealth Management reports, you'll see that the companies winning in the software space are the ones that make workers more productive, not the ones that try to replace them overnight. The risk of further insider selling is something that cannot be ignored. When a CEO sells 45,000 shares every few days, even if it's under a pre-arranged plan, it creates a constant supply of shares that must be absorbed by the market. If the demand from institutional buyers isn't strong enough, the stock can easily drift lower even on good news. This is why the price action today is so vital. Seeing the stock up over 5% on a day when there isn't a major headline suggests that the market has finally finished absorbing the recent selling pressure from the top. If you are managing your own Fidelity IRAs or using the Robinhood app for fractional shares, you have to decide if you believe in the long-term vision of agentic automation. The expectation is that AI will be a commodity, but the reality is that the data and the processes are the proprietary moat. UiPath has the process data. They know how companies work because their robots have been sitting on employee desktops for years. That is a dataset that a generic LLM from a big tech company doesn't have. In summary, the movement we are seeing in UiPath today reflects a market that is starting to separate the real AI winners from the hype. The stock is currently priced as a turnaround story, but the financials suggest the turnaround has already happened. The company is profitable, revenue is growing, and they are sitting on $1.6 billion in cash. The expectation was that they would be crushed by the new wave of AI. The reality is that they are providing the infrastructure that makes that AI useful for the world's largest companies. As we head into 2026, the catalysts to watch will be the adoption of the new Agent Builder tool and whether they can push their net retention rate back above 115%. If they can do that, the current price of $16.90 will look like a steal in hindsight. But if the growth stalls and the insider selling continues to outpace institutional buying, the stock could remain in this range for several more quarters. It is a high-stakes environment where the difference between a legacy software company and a future technology leader is thin. For those who are active in online investing, whether through a SoFi trading platform or Interactive Brokers platform, the volatility is the opportunity.